Hi, this is Yanni Lambros with Berkshire Hathaway Fox and Roach Group.
And this is Kevin Hollenbeck with Centennial Lending Group.
And we're here today to talk about the 720 credit score myth. So a lot of people that I've been talking to, they're really worried about even talking to a lender because they believe that you guys won't even want to, see them if they don't have at least a 720 credit score. I've had people with 680, 700, and they're really worried. But it's situational. There's a lot of ways that guys like this can help you out, especially this one. So you want to explain?
Yeah. If you've been watching a few of these videos now, or our sessions here, you've heard that word, it depends. And a lot of it does depend. But you can go down to, we can have a 620 credit score and still have a lot of options out there for you for different loan types and can get you qualified for a loan. We can even go below 620. But when you go below 620, there's a few more hoops and things that you need to jump through and a few more things as far as your other parts of your profile that need to be there. But we've done clients down to 580s. And we have other lenders out there that we can go to that can get you even below that. So really, you really don't need to have that pristine credit score. And the other thing good about contacting me early in the process is there are things that I can help you do. I can take a look at your credit report and give you some advice on how to raise your credit score. So maybe you're at a 601 and you don't have as many options, but by paying down a credit card or doing this thing as part of your financial situation, we can get that credit score above 620 or 630, and then that'll get you in a better situation, give you more options for loans, and the higher your credit score, the better your interest rate's going to be. Because honestly, think about it, if your credit score is low, the lender's going to take a little bit more risk, and when the lender takes risk, they usually charge you a little bit more in an interest rate. So it really benefits you to come to me early in the process, let me pull your credit report, and take a look and see what we can do about getting your score up. And one other myth out there, Yanni, I hear a lot of people say, oh, I don't want my credit score pulled, that'll hurt my credit score, that'll hurt my credit score. The first time you pull credit for applying for a mortgage is it does have a couple of point hit, but you're allowed to pull credit within a certain amount of time frame, like 30 days, and your credit score will not be impacted if we have to pull it more than once. So that's just some things out there about the credit score.
Oh, so you're saying if they constantly are pulling it, then it could have a negative effect.
Another thing is you hear somebody, usually when I interview somebody, they'll say, I'll ask them, well, what do you think your credit score is? And they'll say, oh, I did it on this side or that side, and it was 710 or it was 680. And I'll tell them that, well, listen, I really need to pull it because we pull all three bureaus in the mortgage industry, and every lender does it the same way. And the credit score is calculated a little bit differently when you're applying for a mortgage. So it's always important to really get a lender to pull your credit score so you know what your credit score will be for your file versus using Credit Karma or one of those and just thinking that is my credit score. Because I've had people say, well, I've had a 660 credit score and they're only pulling one bureau, and I pull it at 680, so it's higher. So it's important to get me involved in the process early so that we can get you pre-qualified so this guy can go find you a home.
So I have one more quick question because credit scores, it's not necessarily everything, but it is important. So, for example, like say I have a client, right, and we're buying a house, they get pre-qualified, and they decide, oh yeah, let's celebrate, and they go max out their credit card because they want to party it up or buy a bunch of new furniture for the house because they're excited. It happens. People do these things.
Yeah.
What happens then?
Yeah, well, it's real important once you get going in this process is that you just delay all those kind of purchases until after you get to the closing table and then you get your new home. There have been clients that have gone out and purchased a new car right before closing. And we've had to fortunately tell them because now they've taken on that extra debt, they no longer qualify for the loan. So we say, we hope you like that car because now you're going to be living in it. Being kidding a little bit, but it really has killed some deals because people have gone out the last minute and bought furniture or done something to impact their credit. And then, because every lender will pull credit right before the closing, just to make sure nobody's done what we're just talking about. Yeah. And then we find that out, and then they can't get the deal, and they lose the home. So
and that would be horrible.
Yeah, that is horrible. That's just a terrible thing to be sitting there, and you got to tell somebody that they're no longer going to qualify for the home because of that. So I always tell my clients ahead of time there's like 10 things not to do once we get in this process, and I'll be glad to go over with that when we're out there looking for a home for you.
Yeah, so moral of the story, call this guy, find out, get your credit score checked. Second moral of the story, have some patience, especially my people, the millennials, okay? Instant gratification is not good this time around. Thank you.
Thanks a lot.